You might hear a lot of noise in the market. People are talking. They say big investors are getting scared. They claim that the large funds and wealthy individuals are pulling their money out of cryptocurrencies like Bitcoin. This story often appears when prices are volatile or when news about regulations seems uncertain. The idea is that the smart money has decided the crypto experiment is over. They suggest these major players are packing their bags and moving on to safer, more traditional assets, leaving the digital currency world behind for good. It's a compelling narrative, especially during a downturn. This story gets louder during market corrections. When prices fall, headlines often scream about a mass exit. Commentators point to falling trading volumes or specific funds closing their crypto desks as proof of a larger trend. They paint a picture of institutions that dipped their toes in the water, got burned, and are now retreating to the safety of familiar investments like stocks and bonds. The narrative suggests that the initial excitement was just a temporary fad. It feeds on fear and uncertainty, making everyday investors question their own positions and wonder if they should follow suit. However, this popular story is not the full picture. It often focuses on short-term movements and ignores the bigger, more significant trends happening behind the scenes. While some investors may adjust their positions, the idea of a widespread departure by big money is a misunderstanding of what is actually happening. The truth is more complex and, for crypto supporters, much more optimistic. The way big investors are engaging with crypto is changing, but their interest is not disappearing. In fact, it is growing stronger and more sophisticated than ever before, just in ways that are not always obvious. The confusion comes from mistaking caution for abandonment. Big investors are naturally careful. They manage huge sums of money and have a responsibility to their clients to avoid unnecessary risks. So, when the market gets choppy, they might reduce their exposure or pause new investments temporarily. This is standard risk management, not a vote of no confidence in the entire asset class. What is often reported as a flight from crypto is more accurately described as a strategic pause or a shift in tactics. The underlying belief in the technology's potential remains, but the approach becomes more measured. Contrary to the rumors, the flow of institutional money into crypto is not drying up. In reality, more money is entering the space than ever before. The data shows a clear and powerful trend. Billions of dollars from large investment firms, hedge funds, and corporate treasuries are being allocated to digital assets. This isn't a small trickle, it's a significant and sustained wave of capital. The primary beneficiaries of this influx are the two largest and most established cryptocurrencies, Bitcoin and Ethereum. These assets are seen as the blue chips of the digital world, attracting the bulk of institutional investment. A major reason for this surge is the introduction of new regulated investment products. Big investors need safety, security, and simplicity. They operate under strict rules and cannot just go online and buy crypto from any exchange. Instead, they are now using regulated options like Bitcoin exchange-traded funds, or ETFs. These products allow them to gain exposure to crypto prices without having to directly own and secure the digital coins themselves. This makes investing much easier and safer, as these products are traded on traditional stock exchanges and are overseen by financial regulators, removing many of the old barriers. Interestingly, a large portion of this new investment is coming from the United States. The recent approval of spot Bitcoin ETFs in the United States has unlocked a massive amount of capital. American investors, both institutional and retail, now have a straightforward and familiar way to add Bitcoin to their portfolios. This has been a game changer for the industry. The United States market is the largest in the world, and its enthusiastic adoption of these new products has sent a strong signal globally. The flow of funds from American investors has been a key driver of the market's strength and resilience. This shift towards regulated products marks a new phase of maturity for the crypto market. It shows that crypto is no longer just a niche interest for tech enthusiasts. It is now a recognized asset class being integrated into the mainstream financial system. The involvement of major financial institutions and the availability of regulated products provide a level of legitimacy that was missing in the early days. This institutional embrace means that big investors are not leaving. They are just arriving in a more official and structured way, ensuring the asset class is here to stay for the long haul. So why do big investors remain so interested in crypto, even with its famous price swings? One of the biggest reasons is their fundamental belief in the underlying technology. Blockchain, the system that powers cryptocurrencies like Bitcoin, is seen as a revolutionary innovation. It offers a secure and transparent way to record transactions and transfer value without needing a traditional intermediary like a bank. Investors see long-term potential in this technology to disrupt many industries from finance to supply chain management. They are betting on the technology's future, not just the daily price of the coins. Another key reason is diversification. Smart investors know that it is risky to put all their money in one place. They are always looking for assets that do not move in the same direction as the stock and bond markets. Cryptocurrencies often behave differently from traditional assets, which makes them an attractive option for spreading risk. By adding a small amount of crypto to a large portfolio, investors can potentially protect their overall wealth during times when other markets are struggling. This diversification benefit is a powerful motivator for large funds managing billions of dollars. Of course, the potential for very high returns is a major draw. While crypto is risky, it also offers the chance for significant gains that are hard to find in more traditional markets. Early investors in Bitcoin and other digital assets have seen incredible profits. While past performance is no guarantee of future results, big investors are attracted by the possibility of capturing the next wave of growth. They understand the risks involved but are willing to allocate a portion of their capital in the hopes of achieving outsized returns that can boost their overall performance. Finally, access to crypto has never been easier, and it offers unique features like inflation protection. With new products like ETFs, investing is simple and secure. Furthermore, assets like Bitcoin have a fixed supply, with only 21 million coins that will ever be created. This makes it different from traditional currencies, which governments can print more of, potentially causing inflation. Some investors see Bitcoin as a form of digital gold, a store of value that can protect their wealth from being eroded by inflation over the long term. This combination of easy access and unique economic properties keeps big investors firmly interested. It is important to remember that big investors are not putting all their money into crypto. They are sophisticated players who build balanced and diversified portfolios. While their interest in digital assets is growing, they continue to invest heavily in a wide range of other areas. Traditional stocks remain a cornerstone of their strategies, particularly in stable, high-growth sectors. They look for strong companies with proven track records and innovative business models. The stock market provides a level of stability and predictable growth that helps balance the more volatile parts of their portfolios, including crypto. Managed funds and private investments are also a huge part of their strategy. Many big investors put their capital into managed funds, where professional managers make decisions for them. They also engage in private equity and venture capital, investing directly in promising young companies before they go public. The tech and healthcare sectors are especially popular for these kinds of investments. By funding the next generation of startups in areas like artificial intelligence, biotechnology, and software, they aim to get in on the ground floor of major innovations, securing high returns over the long term. Real estate also continues to be a favorite asset for big investors. Property, whether commercial or residential, is seen as a stable, tangible asset that can provide a steady income stream and appreciate in value over time. It offers another layer of diversification away from the financial markets. From office buildings and shopping centers to large-scale housing developments, real estate provides a sense of security and physical presence that digital assets cannot. This commitment to physical assets shows that investors are building robust portfolios designed to withstand turbulence in any single market. In this context, it becomes clear that big investors are not leaving crypto at all. Instead, they are finding new and smarter ways to include it in their broader investment strategies. They view crypto as one important piece of a much larger puzzle. The narrative of an institutional exodus is simply wrong. The reality is one of integration. Big investors are embracing crypto through safer, regulated channels and adding it alongside their holdings in stocks, private companies, and real estate. They are not running away. They are strategically moving in, positioning crypto as a key component of the modern diversified portfolio.